As of Tuesday, January 20th, 2026, the market for Palantir Technologies Inc., trading under the ticker symbol PLTR on the NASDAQ, is currently closed. The stock finished the most recent session at 170.97 USD, representing a decline of 6.10 points or 3.44%. While the headlines today focus on this sudden dip, the reality of what is happening under the hood of this software giant is far more complex than a simple red day on the charts. Most people looking at their screens right now see a stock that is finally showing signs of fatigue after a massive run. But if you look at the institutional order flow, something very different is taking place. The expectation among retail traders is that Palantir has reached a temporary ceiling, especially with a valuation that looks stretched by every traditional metric. However, the reality is that the largest asset managers in the world are currently using these pullbacks to increase their positions while the general public panics about short-term volatility. When you look at the price of 170.97, you have to realize that Palantir is currently caught in a tug-of-war between two massive forces. On one side, you have the momentum crowd, who treated it like a lottery ticket during the recent surge in artificial intelligence software. On the other side, you have the fundamentalists, who are terrified of a price-to-earnings ratio that currently sits above 400. This created a scenario today where any slight macro pressure resulted in a quick 3% drop. But what most investors missed today was the volume behind that move. This was not a capitulation. This was a strategic rotation. We are seeing funds move capital out of high-flying software names and into some of the semiconductor giants that had a stronger showing this morning. If you are using a platform like Interactive Brokers or checking your positions on the Robinhood app, you might have noticed that the entire software sector felt heavy. This isn't just about Palantir. It is about a broader shift in how the market is pricing growth in 2026. If you are handling your own self-investing through an individual brokerage, it is easy to get spooked by a 3.44% drop. You might be looking for investment help or searching investing sites to find out if there is some hidden bad news. But the truth is, this movement is perfectly healthy for a stock that has climbed in the quadruple digits over the last few years. The expectation was that Palantir would sail through the 180 level without looking back, especially after the latest round of price target upgrades from firms like Citigroup, who see this going toward 235. The reality, however, is that the market rarely moves in a straight line. We are seeing a classic sell the news reaction to the anticipation of the February 2 earnings report. Traders are locking in gains now so they don't have to sweat the volatility of the actual announcement. Let's look at the institutional side for a moment, because that is where the real story lives. Florida Trust Wealth Management recently increased their stake by over 110%. That is a massive vote of confidence from a firm that manages significant capital. At the same time, we saw Americana Partners trimming their position. This creates a fascinating dynamic. The big players are not in agreement. This creates the liquidity needed for the stock to stay active. If you are using Fidelity Wealth Management or keeping an eye on your Fidelity ETFs, you probably see Palantir popping up in more institutional portfolios than ever before. It is no longer a speculative meme stock. It has become a core holding for many growth-oriented funds. Even the Norges Bank and Kingstone Capital have initiated multi-billion-dollar stakes recently. This institutional backing provides a floor for the stock that simply didn't exist 2 years ago. The way people are choosing to invest online has changed, and Palantir is the poster child for this new environment. Whether you are using the Fidelity mobile app to check your Fidelity IRAs, or you prefer the streamlined interface of SoFi Invest, the accessibility of data has made everyone a bit more reactive. When a stock like Palantir drops $6 in a day, the notifications start hitting everyone's phones. This triggers a wave of retail selling that often overshoots the actual value of the news. For those engaged in online investing through Schwab Intelligent Portfolios or similar automated systems, these swings are just noise. But for the active trader, using the Interactive Brokers platform, today provided a series of interesting entry points near the 170 level. One of the things that makes Palantir so unique is the way it has transformed its business model. For years, the knock on the company was that it was too dependent on government contracts. People thought it was just a defense contractor with a fancy software wrapper. The reality today is the commercial segment is on fire. Their boot camps have become a legendary sales tool, allowing companies to see the power of the artificial intelligence platform, or AIP, in a matter of days rather than months. This has led to a surge in U.S. commercial revenue that is now rivaling the government side of the house. When you look at the 62% revenue growth they reported in the last quarter, most of that energy is coming from the private sector. Companies are realizing that they don't just need AI, they need a way to organize their data so that AI can actually do something useful. That is the gap Palantir fills. If you were using the Robinhood trading platform, or perhaps looking into SoFi stocks for your long-term portfolio, you have to ask yourself if you believe in the long-term utility of data integration. The expectation is that every company will eventually have a digital twin of their operations. The reality is that very few companies have the technical expertise to build this themselves. They need a platform like Palantir's Foundry or AIP to act as the operating system for their enterprise. This is why we see partnerships with companies like NVIDIA and Snowflake. Palantir isn't competing with the hardware makers, it is providing the software layer that makes the hardware valuable. This is a very different business model than what you see with Apple stock or even Tesla stock. While those companies rely on consumer hardware cycles, Palantir relies on the persistent, growing need for organizational efficiency. Speaking of Tesla stock, there is an interesting psychological link between the two. Both companies have a cult following and a visionary leader. Investors who hold Tesla stock often find themselves drawn to Palantir because they see a similar potential to disrupt an entire industry. However, the reality of the business cycles is very different. While Tesla has to deal with the physical realities of manufacturing and global logistics, Palantir is a software-first company with high margins and recurring revenue. This is why you see so much interest in PLTR on platforms like Robinhood Investments and Robinhood Crypto Circles. It appeals to the same demographic that wants to be on the right side of a massive technological shift. Let's talk about the competition for a second, because that's where the expectation versus reality framing gets really interesting. Most people think Palantir is competing with big consulting firms or internal IT departments. The reality is that they are in a league of their own when it comes to the ontology of a business. They don't just provide a dashboard, they provide a living model of how a company functions. This is why customers like Airbus and Ferrari are so vocal about the benefits they've seen. If you are looking for investment help and comparing different software stocks, you'll find that few have the same level of customer stickiness. Once a company integrates its entire data supply chain into Palantir, moving away from it becomes almost impossible. That is the kind of moat that investors like to see when they are doing online investing. If you're managing your own money through a Fidelity brokerage account or using the Interactive Brokers trading tools, you've likely seen the debate about Palantir's valuation. It is the elephant in the room. A price-to-earnings ratio in the 400s is objectively high. The expectation from the bears is that the stock must eventually crash back to earth to align with its earnings. However, the reality is that the market is willing to pay a premium for a company that is essentially a monopoly in its niche. We saw this with NVIDIA for years. People kept waiting for a pullback that never really came, or if it did, it was quickly bought up. Palantir seems to be following a similar trajectory. It has become a must-own name for anyone betting on the future of enterprise software. I want to pause here for a second and get your take on this. Comment below how many shares of Palantir stock you currently hold and what your average cost basis is. Are you a long-term holder from the direct listing days, or did you just jump in during the recent surge? I'm curious to see if the sentiment here matches the price action we saw today. Now, looking toward the February 2 earnings report, the tension is building. The market expects a beat because Palantir almost always beats, but the reality is that a beat might not be enough this time. Because the valuation is so high, investors are looking for a beat and raise on a massive scale. They want to see that the guidance for the rest of 2026 is even higher than originally anticipated. If Palantir just meets expectations, the stock could see a further decline as the priced for perfection narrative takes hold. This is the risk of holding high-growth stocks in an individual brokerage account. You have to be prepared for the volatility that comes with these high-stakes announcements. For those of